Hi class, welcome to this video. This video is going to focus on textbook exercise 8.4, which you'll find in your textbook on page 173 and on your workbook on page 148. So if you're working along with me, you will have both open. And this question focuses on a return by a customer. When we are talking about a return by a customer, we are talking about a sales return. What is a sales return? It is when we as a business have made a sale to our customer, and in our course in VCE, we assume it is a credit sale, and our customer is unhappy with all or part of what we've sold to them. They might be unhappy because it's damaged, it doesn't meet the specifications, whatever. And they return it to us. So we're going to be asked to reverse some part of our sale in this question. Let's read through the question, think about what we have to do, and then we'll complete this question. And maybe so we fully understand the process of sales returns, do a few transactions and a few debits and credits that aren't specifically part of the question, so we really understand the process. Let's read through the question and highlight the important components. Glynn's Glassware sells goods on credit to Zeta Zeta. We know it's a sales return, so if we've done the sale, we are Glenn Glassware, and we've done it to Zeta Zeta. This sale was for $600 plus GST of $60, and we did this sale on the 12th of July. So we might, as part of this question, record that transaction as well. The key important bit for us though is on the 13th of July, Zeta complained that 3 items had marks on them, so hence we can say that they are damaged, and requested a credit. Remember, the source document always comes from the business that receives the damaged goods. We have issued a credit note, and we have a number here, stipulating that a credit of $150 has been approved, along with a credit for $15 of GST. So we have given them $165 back, or reversed $165 of what they owe us. And the cost price of the goods being returned is $65. And you might remember, the business that writes the credit note, the business that records this transaction, is the one that is going to determine the cost price. What are we asked to do here? We're being asked to prepare a journal entry for the credit note. So we're going to be asked to work out the debits and credits for the 13th of July, and then work out and prepare the accounts receivable account for Zeta and Zeta in the general ledger. We're going to try and work out how much Zeta and Zeta owes us at the end of this month. We are not asked here to record the sale on the 12th of July, but it's really important for us to understand the process of a sales return to actually do this part. To do this part, we need to have a really good understanding of our debits and credits. And just to repeat it, let's go through our cheat sheet so we understand debits and credits. If you fully understand them by now, that is great. You're welcome to skip this part of the video. Paler is our cheat sheet for debits and credits. Assets equal A, liabilities equal L, expenses equal E, revenue equals R, and our capital is P, because P equals proprietorship. Capital equals how much our business is worth. Proprietorship is our owner. So it's really saying how much is our business worth to our owner, which is capital. We only need to know one debit or credit to be able to fill in the gaps, and that's the beauty of Paler. The one that I always remember, that an increase in an asset, is a debit. And we put it in the top above the A because of the arrow meaning increase, decrease. So the arrow means we put our increases here and our decreases here. We then fill in the gaps with a pattern credit, debit, credit, debit, credit. So that means an increase in revenue is a credit. If a debit is an increase in an asset, that must mean a decrease in an asset is a credit, and then we then fill in the gaps, repeating the debit, credit, debit, credit, debit pattern. We've now got our cheat sheet to do our debits and credits. We are going to do a part of this, a transaction that's not asked of in this question, just to fully demonstrate how a sales turn works, and that is the sale on the 12th of July. What has happened on the 12th of July? We have made a sale. We made this sale on credit. And we made a sale for $600 plus GST. So let's think through how much is owed to us now. Hopefully you remember, if we make a sale on a credit, that means we have an accounts receivable. You wouldn't abbreviate it, but I'm just doing this to save some space. We have an accounts receivable now called Zeta and Zeta due to a sale on the 12th of July. How much does Zeta and Zeta owe us on the 12th of July? $660. Why have I done a debit? Because accounts receivable is an asset that has increased. And we know that an asset that has increased is a debit according to Paler. Now you might remember there are actually 5 parts of a sale in terms of debits and credits. What are the other ones? We have made a sale, which is revenue increasing. Revenue increasing is a credit, and our sale is $600. Because we don't record all of it as a sale, and I apologize, that is totally wrong. That should be a credit, because a revenue increasing is a credit. The other part of our credit here is GST clearing, which we would think as a liability increasing. A liability increasing is a credit, and there was $60 of GST. Why is it a liability increasing? Because we have received GST as part of this sale. What we owe to the government, so hence a liability, is determined by what we receive minus what we pay. So what we've received has increased, and that means our liability is increased. Did we make $600 of profit because of revenue minus expenses is profit? We have no expenses? Of course not. We also have another part of this transaction which we don't know enough information to write the exact numbers, but we do know that we would have also done a cost of sale, which is an expense increasing of something, and also recognize that our inventory, which is an asset, has gone down, which would have been something as well. And our profit would have been the $600 of sales minus our cost of sales, because we ultimately bought our inventory for something as well. That would be the 12th of July. And we're going to jump ahead. B asks us to prepare the accounts receivable for the entire month. And we have a debit here of $660 for that accounts receivable account. So we need to record that in our ledger, and it might be repetitive if you've watched a few videos. We know that a debit, all that means is left-hand side of the ledger, and a credit equals the right-hand side of our ledger. So we're going to pick this information up and record it in our left-hand side of our ledger, because a debit equals the left. On the 12th of July, we have $660 due to an increase in our accounts receivable. What is our cross-reference? Remembering this middle section is our cross-reference. the other side of the transaction, the credits. There are two credits that equal our $660. So we have sales and GST clearing as our cross-reference. So that is the first transaction, and even though it's not asked you to do this as part of your question, you do have to think this through for part B. What you are asked to do, and why it's important to understand that first question, is to record a sales return. You're asked to record what happens on the 13th of July. So let's put our date in because we know that now anyway. What is a sales return? A sales return is actually going to be reversing part of that sale. So we had a really good result on the 12th of July. We made a sale. The 13th of July, our customers rang up and said, we are not happy with some of it. Reverse that part of the sale. I'm not going to pay you the money, understandably, for the bit that I'm not happy with. How much is this bit that they're not happy with? And we've agreed, because we've issued a credit note, we've agreed to reverse $150 of what they owe us, plus the $15 of GST that they owe us. So what has actually happened here? The amount that they owe us has gone down by $165. And I'm going to do it slightly wrong in terms of the order because we're going to show our thinking process, and this would be okay in a SACA exam as well. Our customer, accounts receivable Zeta and Zeta, owe us less $165, which means our asset has gone down. Our asset has gone down, and we know that our asset's going down is a credit. What has also happened here? We have to reverse our sale. We no longer get to record our sales or part of it. Now, normally that doesn't mean that we just debit sales because sales was our revenue number. Decreasing revenue is a debit, because you might remember there is a specific ledger called sales return, where we record decreases in revenue because of sales return. And it's important because we need to know this number of how much has been returned to our business, because this gives us important information that we might want to address. Also, our GST clearing has gone, if we think of it as a liability, gone down, because we're going to receive less $15 GST. That is $15 less GST we have to give to our government, so our liability goes down. Our profit, however, if we think of this as revenue going down, is not going down by $150, because we also recognise that we're going to have more inventory coming back to our business. We record our inventory at cost price, and that means we have more inventory coming into our business, which means inventory, which is an asset, is going to increase, which is a debit. And we're going to reverse, so we think of our expenses as going down, our cost of sales, so $65 of our expenses are going to decrease. So it's one of the very, very, very rare occasions where we're going to record a revenue and an expense decreasing, which means we're going to record it as use that part of payroll that we ultimately often ignore, because we're reversing the sale that occurred on the 12th. We're asked to, or we're not told that we shouldn't do a narration, so we would definitely do a narration here to get full marks. Something along the line telling us the story, return of goods by customer due to damage. We want to explain why. And then very, very importantly, we would write that we have a credit note as a source document to get all the information. That would be the perfectly recorded general journal entry to record a sales return. Now, you wouldn't have to record the part of the 12th, but you do need to understand it to be able to think through how we're reversing it. And now we're going to do the last little part of our accounts receivable. We originally recorded that we have $660 as our accounts receivable owed by Zeta and Zeta, but that has gone down by $165 on the 13th of July because we have a credit here of accounts receivable. What is our cross-reference? The debits that equal 165. Be really careful here. It's not sales, it's sales return and GST clearing. We've now done all the hard part. Don't fall in the trap. We're going to have to balance this. Let's just assume we do. How do we balance? We add up both sides and write the total of the biggest number in both. And then we're going to work out what's the difference to make sure it does balance. That is $495. So on the 31st of July, we have a balance. And then we bring this down to the other side on the next day of the next month. So on the 1st of August, balance $495. What does that mean? Our customer, Zeta and Zeta, owes us $495 on the 1st of August. That would be what we would put in our balance sheet as part of Zeta and Zeta, and that is what we would ultimately be saying how much we expect Zeta and Zeta to pay us. We have now done quite a difficult question, a sales return, and thought through the ultimate process. And all we want to be thinking is a sales return, even though it seems quite complicated, is how do we reverse a sale? So if you understand how to record a sale and the 5 debits and credits that we record, a reverse occurs when we have a sales return. How do we reverse something in the world of double entry accounting with debits and credits? If we've recorded a credit, how do we reverse that? We reverse that with a debit. If we've recorded a debit, we reverse that with a credit. And all the information for that question will either be in a transaction, like I've been written here, or in a credit note source document. Well done, guys, to getting to the end of this question. Now's your chance to do a number of textbook exercises to consolidate your understanding of sales return.